Kia ora, and welcome to the CoreLogic Property Market Update for Paenga Whawha, April 2025. Brought to you by Loan Market. The Aotearoa housing market recovery continued in March, with property values increasing 0.5% over the month to a median value of just over $812,000. This takes the total increase across the first 3 months of the year to 0.9%, reaffirming the upturn has begun, though it is expected to remain modest. Over the first 3 months of the year, nationwide sales volumes are up 5.4% year on year, benefiting from falling mortgage interest rates and increased confidence. Still high listings volumes have held back any desperation from buyers, though the flow of new listings has been relatively consistent with previous years, and now paired with increased sales activity is leading to total listings dipping a bit earlier in the year than usual. This could bring more balance to the market, which is currently favouring buyers. Across the main centres, transactions are higher than last year, though to a varying degree, with Kirikiriroa Hamilton sales volumes up 24.1%, but things are a little more constrained in both Tamaki Makaurau Auckland and Te Whanganui Atara Wellington, up only 0.7% and 0.4% respectively. It should be noted, Kirikiriroa Hamilton's strong lift is partly reflective of base effects, where the market took a while to get going at the start of 2024, so it's comparing to a relatively low base of sales last year. The trend of 5 to 10% growth in volumes in Tauranga, Ōtautahi Christchurch, and Ōtepoti Dunedin then is much more than norm, as are minor shoots of value growth across the country. Only 3 of the main urban areas tracked saw values decline in March. Te Awa Kairangi ki Uta, Upper Hutt, down 0.2%, and Whakatu Nelson and Ōtepoti Dunedin down 0.1%. In contrast, values in the Kapiti Coast increased by 1.4% in March, while Kirikiriroa Hamilton values increased by 0.9%, and values in both Ōtautahi Christchurch and Whanganui increased by 0.8%. The general trend of value growth across the country is supported by declining interest rates, and with global economic growth forecasts being reduced, there is scope for interest rates to fall further than previously expected. But uncertainty is very high, given the ever-changing global trade environment, courtesy of the US tariffs and their subsequent trade war with China. Equity markets are proving very volatile in response, and while reduced global economic activity will weigh on labour market conditions around the world, this may be partly offset with a flight to safety of the bricks and mortar of residential property. This could especially be the case if inflation remains within target, allowing central banks to support their local economies with reduced interest rates. The recent Reserve Bank of New Zealand monetary policy review reinforced this view, repeatedly emphasising a focus on the medium-term horizon and a willingness to look through short-term volatility. The bank also expressed relative confidence that inflation will remain below 3%. The 25 basis point cut to the OCR, now at 3.5%, was widely expected and should be followed up with another one at the end of May. From there, the timing and size of cuts will very much be data dependent, so it'll be well worth paying attention to measures of inflation and the economy over the next few months. Prospective buyers and current borrowers will certainly be doing so. Over 80% of all mortgages are either floating or set to refix on a new rate within the next 12 months, the majority of which will be lower than their current rate. This is an important thread in building the economic recovery, as reduced mortgage commitments are expected to increase disposable income, with that flowing through to increased spending in the economy. New mortgage commitment data illustrates we could be nearing a trough for mortgage rates, with some borrowers starting to select longer term. Still fewer than those floating or selecting 6 or 12 months, but there was a noticeable lift in greater than 12-month terms in February, no doubt partly swayed by sub 5% rates on offer from many of the banks. In terms of different buyer groups, we have seen increased activity across the board, but a slight shift in the share of sales. As suspected, first-home buyers saw their share decline slightly in the first quarter of the year compared to last year, from roughly 26% to 24.8%. Importantly though, they actually bought more properties, almost 6,300 across January to March this year, compared to less than 5,900 in the same months last year. Mover activity remains below their long-term average of around 28%, at 26.3% this year, while mortgage multiple property owner activity has continued its slow recovery, up to 23% in 2025, from roughly 21% at the start of last year, though below their long-term average of around 25%. The financials have definitely improved for property investors through looser regulation and lower interest rates, but debt-to-income restrictions will play more of a part later in the year in limiting their ability to buy. We are in a time of great uncertainty, with expectations changing daily, so make sure you stay on top of all the latest housing market data and insights by following our news updates on the CoreLogic NZ social channels, including LinkedIn, Instagram, X or Facebook, and subscribe to the New Zealand Property Market Podcast on all good podcast players. Mā te wā.